Imagine a colossal titan, a financial behemoth, suddenly crumbling to dust. Yes, we're talking about Silicon Valley Bank's shocking collapse. A bank that once stood as an emblem of Silicon Valley's burgeoning economy and startup culture, but then found itself spiraling into an abyss of financial ruin. This was not a slow descent into oblivion. The collapse was swift and brutal, leaving many in disbelief. One moment, Silicon Valley Bank was a key player in the world of finance, and the next, it was gasping for breath, grappling with a rapid rise in borrowing costs and a devaluation of assets. The aftershocks of this collapse were felt far and wide, with startups scrambling to access funds and cover expenses, and even toy companies like Camp reaching out to customers for support. But, amid the chaos, there was a glimmer of hope. The government stepped in, orchestrating a rescue effort that led to the acquisition of Silicon Valley Bank by HSBC, a move that saw HSBC gain a cool $1.6 billion. Meanwhile, competitors like JP Morgan and CIBC seized the opportunity to intensify their efforts in the startup and venture capital market. This unexpected turn of events had regulators on high alert, monitoring social media to prevent bank runs and carefully assessing the contagion risks in the banking sector. Their focus? Commercial real estate loans, a sector already teetering on the edge of instability. Yet, the damage was done. The collapse of Silicon Valley Bank had set off a domino effect, sparking concerns about the overall stability of the banking system. This led to lawmakers calling for stricter regulations and accountability for the bank's executives, further fueling market volatility. The bank's collapse was a startling event that sent shockwaves through the financial world. But what led to this spectacular downfall? The collapse of a giant doesn't happen in isolation. It sends ripples through the economy, affecting lives, businesses, and other financial institutions. The fall of Silicon Valley Bank was no exception. The reverberations were felt far and wide. Competitors like JP Morgan and CIBC found themselves in a peculiar position. On one hand, the void left by Silicon Valley Bank's collapse presented opportunities. They could intensify their efforts in the lucrative startup and venture capital market. But on the flip side, they also faced the daunting task of navigating an uncertain financial landscape, riddled with potential contagion risks. These risks were particularly prominent in one sector: commercial real estate loans. The collapse of Silicon Valley Bank, a significant player in this market, raised concerns about the stability of these loans. The worry was that defaults could spread like wildfire, toppling other banks in a domino effect. And while the regulators were doing their best to prevent such a scenario, the fear persisted. The fallout was not limited to banks alone. Startups and small businesses, once buoyed by Silicon Valley Bank's support, found themselves thrown into a sea of financial uncertainty. They faced challenges in accessing funds, covering expenses, and even keeping their doors open. The impact was not just about numbers on a balance sheet. It was about dreams and livelihoods hanging in the balance. The domino effect continued to ripple through the economy. It highlighted the interconnectedness of our financial institutions and the risks that come with it. It underscored the need for stringent regulations, accountability, and most importantly, preparedness for such crises. But it also brought to light the resilience of the market. Despite the turmoil, the stock market ended the week with gains, demonstrating that even in the face of adversity, there is room for optimism and growth. The collapse of Silicon Valley Bank was more than just a bank failure. It was a wake-up call to the fragility of our financial system. It reminded us that the ripples of one giant's fall can touch every corner of the economy. But with every crisis comes an opportunity to learn, to adapt, and to build a stronger, more resilient financial system for the future. In the aftermath of a disaster, it's crucial to understand the causes and learn from them to prevent a repeat in the future. So let's delve into the circumstances surrounding the collapse of Silicon Valley Bank. A rapid rise in borrowing costs played a significant role. As interest rates increased, the bank found itself in a precarious position, with its assets devaluing and funding shortfalls becoming more apparent. These financial difficulties mirror the challenges faced by many startups during this period, highlighting how interconnected our financial ecosystem truly is. But it wasn't all doom and gloom. In response to the crisis, regulatory bodies stepped up, providing much-needed reassurances. The measures put in place following the 2008 financial crisis proved instrumental in containing the fallout. The government's intervention, including deposit guarantees and funding programs, showed the strength of our post-crisis reforms. Moreover, the crisis has led to an increased focus on monitoring social media to prevent bank runs. In a world where information travels at the speed of light, it's vital to keep a pulse on public sentiment and respond swiftly to prevent panic from escalating. Yet, despite these measures, the incident has left an indelible mark on the banking sector. Fears persist about contagion risks, particularly related to commercial real estate loans. Banks like New York Community Bancorp have had to raise significant capital to avert disaster, demonstrating the far-reaching implications of such a crisis. So, what can we learn from this? For one, vigilance is paramount. In an ever-changing economic landscape, banks must remain alert to shifts in market conditions and adjust their strategies accordingly. Transparency, too, is crucial. Clear, consistent communication can help instill confidence and prevent panic. And finally, robust regulation is key. The role of regulatory bodies in mitigating the crisis underscores the importance of strong oversight in maintaining a stable financial system. The lessons from Silicon Valley Bank's collapse are clear. Vigilance, transparency, and robust regulation are key to a stable financial system. The story of Silicon Valley Bank's collapse is a stark reminder of the volatile nature of the financial world. It underscores the necessity of vigilance, the value of understanding complex economic dynamics, and the importance of staying informed. This tale of a banking Goliath's downfall, the ripples it caused, and the lessons learned, is just one of many we delve into. For more stories that peel back the layers of the financial world, that unpack the intricate interplay of economics and industry, don't forget to subscribe. Stay tuned, stay informed, and remember to hit that subscribe button for more insightful content on the world of finance. Until next time.